if you invested $10,000 in NEO stock in 2019, you would have $16,495 today. That is, if you've put $10,000 into NEO stock on March 22nd, 2019, you will have earned 64.95% return on your investment in just 4 years. That's an incredible return, but how did NEO stock get there? That's what I'm going to talk about in this video, as well as answer if it's too late to buy NEO stock today. That is, if you're interested in buying NEO stock, is it too late for you to experience these kinds of returns in the future? I'll answer that question towards the end of this video, but let's begin with how NEO stock got to this point. So, starting with, of course, in the aftermath of the pandemic, electric vehicle stocks were in high demand. I mean, they were soaring all over the place. Nearly every stock that had to do with the EV industry absolutely exploded. NEO stock, you can see here in 2020, look at that explosion. It ran all the way up to being up over 800% from the levels it was at in early 2020. Now it's given up a lot of those gains over the last couple of years, but it's still up 65% like I discussed at the beginning of the video. But look at this explosion. I mean, and this was common among many EV stocks. Tesla, you can remember how much Tesla stock jumped. Rivian exploded. There were several others that absolutely exploded, and that was a result of people being at home, people having more dollars to invest in the stock market, and electric vehicle stocks being some of the most explosive in terms of high growth potential, high growth revenue, long-term secular tailwinds. Everyone understood that governments worldwide were supporting the expansion of electric vehicles and renewable energy, and so that drove a lot of investment enthusiasm into this industry. But at the same time, let me show you this stat here. Look at NEO's revenue growth quarterly year over year. NEO was helping support that investor enthusiasm by delivering explosive revenue growth. Look at this. Revenue grew nearly 200% for a few quarters, and then over 400% for a quarter, and then dropped back down, but still very robust. Overall, it's grown revenue at over or roughly over 40% in the entire time over these last several years. So it's ramping up production, it's growing, it's adding to its battery swap technology network. This year it plans to add almost 1,000 new service locations for its battery swap technology, which then makes it more convenient for people to buy NEO's cars, because then they have places where they can go and swap the battery and be on their way and continue driving. That's one of the sticking points with electric vehicles, is that long time to charge. NEO aims to alleviate some of those concerns by choosing the battery swap option instead of just having the battery charging option, which can take much longer. So NEO was supporting that investor enthusiasm by delivering robust revenue growth. And at the same time, if you look here, this is now the chart for net income over the trailing 12 months. Initially, it was showing, even though its net income was negative, it was showing improvement in this metric. You see here with each quarter, net income, the losses were shrinking. It was making progress towards profitability. And if we look back here, that coincides around the same time that the stock price was exploding, right? Because if you watch my channel, one of the things I'm very, very adamant about when I'm looking at growth stocks is for these growth stocks to be making progress towards profitability. I don't mind if they experience slower growth just so that they can demonstrate that they're making progress towards profitability. Well, NEO was making progress towards profitability and growing revenue absolutely explosively. So you were getting the best of both worlds with NEO. You were getting accelerating revenue growth at very high rates, and you were getting progress towards profitability. That 1-2 punch was really exciting for investors, and you can understand why the stock price exploded so much in 2020 and very early 2021. However, those good times came to an end. NIO's cost of goods sold started to rise, supply chain disruptions started to increase, competition among other EV companies started to increase as all of these companies started to ramp up production. And then you had the legacy car companies like Ford and GM and Mercedes and Honda and all of them ramping up their EV production. And so competition for materials, for labor, for all of that increased, making it harder to ramp up production and more expensive to ramp up production. And then you had NIO's turnaround. Instead of making progress towards profitability, every quarter it just lost more and more money on the bottom line, to the point where in the trailing 12 months, most recently, it lost $2.129 billion. And that coincides with the stock price coming down, okay? And in addition to the net income coming down during these last several quarters, at the same time, the overall market investors became less interested in investing in unprofitable growth stocks. As the Federal Reserve started raising interest rates and the cost of capital started increasing, investor focus shifted from these high growth, high potential type of stocks to these types of stocks that are growing, but more importantly, that are delivering profitability and positive cash flow from operations, or positive free cash flow, or at least demonstrating progress towards those metrics, which unfortunately NIO was not, because NIO is still in the early stages of its expansion. It's still ramping up production. It's still rolling out its charging network. It just, it's now, if you're not aware, it's primarily in China, focused in China, but it's now expanding into Europe. And so all of these expansion and growth investments are costly to the bottom line, but deliver a higher potential in the long run. But unfortunately, investors are not looking for potential right now. They are more focused on companies delivering cash flow and profits right now or in the near term. And so NIO's stock price has been hurt in recent months, and over since 2022 and early 2021 it's been coming down. But still, if you invested in 2019, you will have made 64.5% already. So now, to answer the question, is it too late for investors to buy NIO stock right now? Can investors expect similar rates of return over the next several years? And to answer that, I'm looking at NIO's price to sales ratio. Its valuation is trading at near the cheapest it has traded for, so at 2.089. It's just about the same valuation as it was before the outbreak, right? Before the price to sales exploded up over 30. So it's, it's less than 1/10 of that valuation that it was. It's like 1/15 of the valuation it was during its peak times. So you're getting a relatively good price to buy NIO stock. Although you're also, if you're interested in buying NIO stock right now, you would be getting it at one of the times where the headwinds are the highest, right? The cost of goods sold is soaring, and competition is fierce. You've heard of all of the price cuts happening in China with BYD, with Tesla, with XPeng, with Ford. Almost everybody is lowering prices on their EVs in China. That's not good news for NIO. That's where it has the highest market share, and that's not going to be good news for its profitability, and it's already losing a lot of money on the bottom line. And at the same time, competition for materials is soaring as many companies are ramping up production. And sales in China for the first 2 months of 2023 are extremely down. They're down more than double digits compared to last year. The Chinese government has removed the subsidy for consumers to buy electric vehicles, and without that government support, buying an electric vehicle suddenly became a lot more expensive, and so that's what necessitated a lot of the price cuts by all of these EV companies. So you would be getting it at a highly volatile, highly expensive time for NIO stock. So can you expect similar returns from NIO stock? I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. I would say it would depend on your time horizon. If you're looking at the next 2 or 3 years, then I would say no. The chances of NIO stock giving you, the type of return it's earned over the last 4 years is unlikely. But if you're looking at an investment time horizon of 10 years, right, then it's more likely that NIO could give you those kinds of returns, because in the longer run, a greater percentage of vehicles are a greater percentage of consumers are buying electric vehicles, and China is the world's largest EV market. That's the market where NIO has the greatest market share among luxury EV buyers, and so it's in a great position to capitalize on this long-running tailwind that's going to go on for several years. So if you're looking at the next 2 or 3 years, then no, I don't think NIO stock would be a good option. But if you're looking at the next 10 years, then you're looking at a better chance of an excellent rate of return in that time frame. All right, so that's all I've got for this video. Thank you always for watching. I appreciate your viewership, and I have some videos that I've hand selected that are popping up on your screen right now. I think you will enjoy those, so please click on one of those and I'll see you over there.